Good day, subscribers! Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're doing part 6 of the very popular series, Stock Market Terminology That Every Investor Should Know. I'm really enjoying sharing this series with you guys, and it seems like you guys are really enjoying it back. So, you know what? Let's just get into this. 10 more terms to pound out today, and we are on part 6. Let's get into this. First term up today, we have public company. A public company is basically a corporation that you can buy shares in as an individual investor. So it's not like, well, I don't want to go into the second term, but a public company is basically when you can invest in it and you don't have to have known the owner, you don't have to know anybody in the company. They just trade on a stock market ticker symbol that's on the NYSE or the NASDAQ or some other platform, and you just buy shares in that. So that's what a public company means, and it means that all their financial information, that all has to be public information. So they can't like hide how much revenue they had last quarter. They can't hide how much profit they had last quarter or anything like that, or last year. That all is public information. How much the CEO makes and the CFO, that is all public information. They cannot legally hide that type of information. All that has to be out there to the public. Who's on the board of directors? That all has to be on the public. So a public company basically is basically what the name is. It's public. You can find out basically any amount of information you want on that company. There's a few secrets they're allowed to hold back, but the majority of things, it is all widely known, and it has to be known to the public. That's a public company. Next one's up is a private company. A private company is complete opposite of that. A private company is a company that they don't have to share anything publicly as far as how much CEOs make or CFOs or any of the executives. They don't have to disclose who's on the board of directors, if they even have a board of directors, how much revenue they make, anything like that, because that can just be like a family-run company. I used to work for a huge corporation that brought in billions of dollars a year, but it was a private company. So we didn't have to disclose what that income was. We didn't have to disclose what the profit was last quarter. We didn't have to disclose how much the CEO is making. None of that stuff needed to be out there because it was family owned. It was owned by the family. So it doesn't matter that it was a huge corporation and 10, 20,000 employees were in the company. All that stuff can still be held privately when you're a private company. So there are definitely some advantages of private companies. I've done actually a video, I believe, in the past on public company versus private company and what's best for a big corporation, those kinds of things. I might have to go back and look. If I haven't, I'm going to do something like that because there's definitely advantages to being a public company. There's definitely some advantages to being a private company. Next term up, term number 3 is quarterly earnings. Quarterly earnings is when a company has to report earnings every 3 months, so 4 times a year. A quarterly earnings is when they report whatever numbers they did for that previous 3 months. So generally the quarters run like this. The first quarter is January, February, March. The next quarter is April, May, June. The next quarter, which is third quarter, is July, August, September. And the fourth quarter would be October, November, and December. That's generally how the quarters run. Some companies run them like 1 month off, which is kind of strange. But anyways, most companies, that is the quarterly process. They announce what their earnings were, so their revenue, what their net income was. They announce developments with the company, what happened with the company in that quarter. Did they get into some new markets? How successful are their products and things like that? Market trends, they get into all that kind of stuff. And that runs into term number 4, which is a conference call. Generally, all public companies have a conference call, which is when analysts call in and ask questions after that company's report their numbers. So generally that company will report their numbers. 30 minutes after that, they do the conference call. And that's when the CEO is on there, and sometimes the CFO, and sometimes a few other executives that are super high up ranking in the company will be on there to answer questions from the analyst community so investors can hear those questions and understand what exactly is going on with that company. So maybe going more in depth and try to get some more information that maybe they didn't call out in that earnings report and things like that. Maybe ask more questions on, okay, why did revenue slip more this quarter, because this and that. So it's really an in-depth process. I love listening to conference calls. I highly suggest you guys start listening to conference calls if you have not begun yet, especially some of the bigger companies. I find them really interesting. Maybe I'm just a super big business stock market nerd, but I find conference calls so fun to listen to. You can learn more listening to some conference calls of some of these guys and gals than you could learn getting a business degree at a school. I'm serious. They give out so many phenomenal tips that the way they talk and explain things, it just really opens up your mind if you're ever going to start a business. So I highly, highly recommend you guys just listen to conference calls, unless you think it's the most boring thing in the world. Some of my favorites are like Steve Wynn at Wynn Resorts. I love listening to him because he can just go off on tangents and things. And the way he explains business, I just really enjoy that. He's about my favorite. There's a lot of tech companies I like, Facebook, Apple. I love to hear all those big companies as well. That's what a conference call is. Next up is number 5. That's market cap. So market capitalization. That is how you basically calculate that is you take the share price, so however much the shares are trading, and you times that by however many shares are outstanding. So let's say the company has a share price of $2 and they have 2 shares outstanding. You take 2 times 2, that means they have a $4 market capitalization. Now, of course, public companies, most of them have hundreds of millions of shares outstanding, if not billions of shares outstanding. And of course, they have share prices that are generally way above $2, which is how they get huge market caps of, in the billions and billions of dollars. Next term up is EPS. What EPS stands for is earnings per share. How you figure out the earnings per share, or the EPS as it's known, is you basically take what the net income is. So let's say the company earned $2 in total net income. That was their net income, $2. And you basically divide that out by how many shares are outstanding. Let's say there was 1 share outstanding. 2 divided by 1, that means there's $2 in EPS. For every 1 share outstanding, they earned $2. Now, of course, the bigger the company, the more complex these numbers are, because you got earnings of hundreds of millions, if not billions of dollars, divided out by hundreds of millions or whatever, or billions of shares. So the numbers are much more complex, but it's basically the same thing. You divide out how much they did in net income, divided by how many shares they have outstanding. That is how you figure out EPS, and that's what EPS is, earnings per share. Next term up is a portfolio. A portfolio is however many stocks you hold and what stocks you hold in your portfolio, basically. So if somebody asks you, hey, what stocks do you have in your portfolio? That means what stocks do you hold? What stocks are you invested in at that time? That's what a portfolio is. Next term up is margin. Margin is when, and what we're talking about, we're not talking about gross margin or net margin or any of that kind of stuff. This is margin when you're investing in a brokerage account. So if you can create a margin account and have margin, which is when you invest money that's not even yours. You're basically taking out a loan to invest more capital because you think a stock is going to go up, or you could be betting that a stock's going to go down big. So margin is whenever you want to invest money that's not yours. And generally you can do $2 for every $1 you have. Sometimes you can go a little bit higher than that if you're more diversified. So sometimes you can get all the way up to close to $3 for every $1 you actually have invested. But generally the term is $2, or $2 total, and say you have $1, you can invest another $1 in margin. Next term up would be a margin call. I've experienced this before when I messed around with margin. I went too heavy on margin. So if you go too heavy on margin and then a stock goes down in the short term, they basically will force you to either deposit more money in your account, or you have to sell your shares within like 3 business days. So I've had to experience that before back when I was messing around with margin. That was a really bad decision. That was very short-sighted on my whole thinking, and I would have margin calls come in, and my brokerage would send me, hey, you know what, you need to deposit $5,000, $10,000 in your account by such and such date, or we're going to sell your shares automatically for you. So if you don't have that extra money to throw in there to your account, you get screwed, and you have to sell your shares, even if it's at a bad price. There's nothing you can do about it, because there's federal regulations that if you get to a certain amount that you don't have in your account, they have to sell. And then also they have their own house rules, and every brokerage is a little bit different. So some brokerages might let you go a little bit. Some might call you in right then and there and say, hey, they have the right technically when you sign up for a margin account to sell at any time. So always remember that. Doesn't mean they will, but they have that right. So keep that in mind if you ever do a margin account, which I do not recommend for anybody. I just do not recommend it. It's important you know it though. Next one is the last term today is actually maxed out. It's not really so much a definition as a saying. Maxed out means when you have a margin account and you have everything invested, or if you just have a regular portfolio of stocks and you have every dollar you could possibly have invested. That means you're maxed out. Hey man, I'm maxed out. I got all my money in all my stocks, or all my money in this stock. I'm maxed out in Apple or whatever stock. I don't have another dime to my name right now. I have it all riding on whatever stock or multiple stocks or short selling stocks, whatever it is. You have everything you possibly have in that stock. That's what it means to be maxed out. It's basically like in poker, you know, when they go all in, they put all their chips on the table. In investing, you call that being maxed out. Thank you for watching this today, guys. 10 more terms. I'm enjoying this series. Next week, we'll do part 7. If you're watching this and you haven't subscribed yet, you may want to. I talk a ton about personal finance on the channel. Talk a lot about business. I'm an entrepreneur. I talk about entrepreneurship. And I talk so much about the stock market and doing series like this every single week. If you're just getting caught up on these terms, you can go back and actually watch a playlist. I have a playlist created for this about the stock market terminology. Thank you for watching, guys, and have a great day.